let's get started here with this one. I saw this last night and I was like, oh, I should react to that. That's an interesting subject, okay? So Tevis had tweeted out this, if they still call it tweeting now, I don't know, maybe they don't call it that anymore. I still call it that. Thinking of going, selling almost all my positions, going all in a 5-stock portfolio. The 5 stocks he's talking about is Tesla, SoFi, Unity, Pins, and Celsius. Okay, so he says these are by far my favorite names. I have the majority of my mind share and conviction. Everything else I don't really look at or am bullish or as bullish on. Okay, so let me first start out by saying this. Okay, I've been in the market like 15, 16 years. There's nothing I haven't probably done in the game. I've gone all in 5 stocks. I've gone all in 1 or 2 stocks before. I've gone on margin before. I've done swing trading before. There's nothing I haven't done. And at the end of the day, what it all comes back to is I'm always better off having a well-diversified portfolio and long-term investing. It's what it always comes back to. Every single time I try to do this or that or try to get a little fancier, ooh, let's go heavy on, riskier stocks, always ends poorly. Whenever I just stay focused on building a great overall portfolio, 10, 15, 20 stocks, and let everything else be everything else, it always turns out the best for me. So let me start out by saying that first and foremost, as somebody that's been in this game a really freaking long time, okay? Next up, what do I think of his strategy of, let's say, going all in 5 stocks? So I don't think it's a horrible strategy if you got a smaller amount of money and you're tighter on time, right? So not everybody has the time to pay attention to 20, 30, 40 different stocks and keeping, listen to all the conference calls and all the investor reports and all those sorts of things. So if you have a smaller amount of money, I can understand just having 5 stocks, right? And I don't know, how much Tevis has or doesn't have, but let's say he has under 50K. Okay, I understand 5 stocks. If you got 25K, 30K, something like that, I understand it, right? But over time, I think it's better to build out a 10, 15, maybe 20 stock portfolio. 20 stocks are starting to get, maybe a little over diversified for some people that are individual stock pickers. Now, what do I think about these 5 stocks? Well, I don't like it. I don't like it at all, okay? First off, Pins, I just don't like it in general. Unity, there's a lot of issues here, okay? A lot of issues. The first issue is he doesn't have a big money maker. One of those companies is a big money maker. Tesla's the biggest money maker of the bunch. And as somebody that's been a Tesla shareholder for like 100 years now, I'm just telling you, Tesla makes very little money compared to the market capitalization of the company. And Tesla, in terms of what they're going to bring in 2024, it's not a big money maker stock in terms of net income wise, right? SoFi's barely getting to infant stages of net income, right? Unity, Pins, Celsius, super high valuation, and they're a smaller money maker as well. So overall, when I look at that, there's a lot of holes there. There's not a lot of diversification between different industries. And where's the big money makers? There's nothing there. And that's the type of portfolio that those type of stocks, if you're in a major risk on market, let's say the next 24 months, 12 months, 24 months, whatever, super risk on, everything to the moon, Bitcoin to 100K, 150K, everybody's, it's back to 2021 vibes, sure, that portfolio is going to do very well because those are all what you would kind of put into more of a speculative, higher valuation category. Let's say we don't have that sort of market and it's, a stagflation type market. Those positions will all struggle immensely in that sort of market. So, that's kind of what I would say about that overall, okay? And it's a thought that goes through a lot of people's minds. They're like, oh man, I just want to go all in. And let me tell you guys what usually, because you got to ask yourself, why do you go there mentally? It really has nothing to do with this part down there. I'll be honest with you guys, okay? On a psychological level, it comes down to one of these 2 things. Either you're going there because you're not making money in the market, and so you're like, gosh, man, I got to start making money, I need a position. That could be one. That might not be the thing with Tevis, but that could be one way. The second way is you are making money, But you're looking and you're like, dang, man, I need to make more money, more money, more money. And that happens a lot of times when you've had a really good market for a while and people are looking out there and they're like, dude, why am I in, this many stocks? I need to concentrate. I need to, so it can happen, and that many times is what kind of pushes you there. It's one of those two scenarios. And if I think about myself before, and I think about the time I was all in like one stock, two stocks, even three stocks, it was usually because I was coming off of a period where I made a lot of money and I was kind of deep down looking back now in being mature about the situation. It was greed. It was just like, dude, like I want to make even more. And if I think about the only other times I've really done that, it was time periods when I hadn't really been making money. And I'm like, dang, man, like, come on. Like I need my fix here. I didn't even start making some money. So, I've seen it all, done it all. That's the name of the game, okay? There's some panic setting in here regarding SoFi. This is out of data-driven investing here. There is a possible tax refund disaster coming for SoFi members and therefore SoFi's reputation. In the words of Reddit's Bender9000, SoFi is slowly walking into a reputation risk disaster. Members are being underserved. Support shows no indication of working to resolve or lessen the issue. Here's what's going on. Members are experiencing rejection of IRS tax refund deposits made to their SoFi banking accounts. This affects members who, 1, file their taxes using TurboTax. TurboTax is insanely popular. It's certainly one of the most, if not the most popular tax-related software out there. So that's a lot of people, okay? 2, elect to have fees paid out of their refunds. And 3, direct the tax refund to be sent to their SoFi banking account. This is where SoFi comes into play, right? When a TurboTax using member elects to have fees paid out of their return, TurboTax processes the refund using Santa Barbara Tax Products Group. SBTPG processes a refund with fees deducted. However, they allegedly code the deposit for a business account instead of a personal account. When the deposit reaches SoFi, it is rejected due to the mismatched business-personal coding. This is the point at which member discovers there's a problem. Once rejected, the deposit is returned to the IRS to be reprocessed as a check, which takes months. Note, the issue does not affect TurboTax members who do not elect to have fees paid out of their refund. This is definitely not good. SoFi needs to be seen as a bank of the future where things run smoothly and work properly. If hundreds of thousands or more members have their tax refunds returned to the IRS, it will reflect very poorly on SoFi, even if the root cause is not their fault. And then he tagged Anthony Noto, SoFi, SoFi IR, all those sorts of things, right? So 100%, right? This is something that has to be taken into account. This is something that has to be fixed ASAP. And, it shouldn't have to come to, I'm assuming this data-driven investor is obviously an investor of SoFi, right? Shouldn't have to come to an account like this to have to alert SoFi what's going on. They should be on top of this, right? It shows a lapse in judgment and kind of being on top of their game. Let's just call it that. Because something like this that is big like this, you shouldn't just let this fall through the cracks. So, hopefully this is handled ASAP, because here's the thing, okay? I'm recording this, it's February 20th. If you get a refund, you file as soon as you possibly can, right? Because you want that money. The people that usually wait to the end are the people that owe money. So naturally, a lot of people are already filing or have filed now at this point in time, are now at that point where they're waiting for their refund. So, mass amounts of refunds are going to be going out, I would say, over this next 3 to 4 weeks. So SoFi has to get on this ASAP, man. And yeah, if this is, at the end of the day, it's all going to fall back on SoFi. If certain things are not ran properly and these checks go back to the IRS, and then the money goes back to the IRS, then the IRS has to send a check and it takes months. It's all going back to SoFi. It's going to make SoFi look bad. Everybody always blames it on whoever their end product is, right? The end, whatever it is. And in this situation, it would be SoFi. So, I don't know, what they can do, but they got to get it fixed. That's all I know, right? That's why you make the big bucks. Get a problem like this fixed in ASAP, or it will cause a lot of reputational harm, no doubt. I saw this one out there. This is out of an account called StockGo. It says SoFi trades at $8 billion market cap. Company sitting on $3 billion of cash. That's 38% of the entire company in cash alone, okay? Listen, it's a bank. It's a really poor way of looking at it. If it was, if you want to look at a Palantir like that, because Palantir is actually sitting on massive cash and no debt, and they don't know a bunch of people deposits and all those sorts of things, okay, you could look at it that way. But I think this is a really poor way of looking at this. And thank goodness somebody else, is a little higher level out there as well. This person, message back. They say, if you're going to talk about a bank's cash, you also need to talk about their debt. SoFi having $3 billion of cash with $5 billion plus in debt isn't nearly the flex you think it is. For reference, Wells Fargo has $433 billion in cash and $315 billion in debt, with a market cap of $186 billion. I say this as a SoFi shareholder, 100%. I think sometimes just people get desperate for, I don't know, I'm just maybe not up to a high enough level to understand a more complex matter like this, or maybe just, looking for something to talk about. I think I'm that when I read that, I'm just ugh. As somebody that I'm now officially a SoFi shareholder. I own some shares in the stock, but I saw something like that. I'm like, oh my gosh. And the problem is other people might eat something like that up and they think, oh yeah, and it's no. It's not what it seems. Okay. Next one up here, Amit posted this. He said, so Walmart crushed earnings, beat revenue by $3 billion, $173 billion versus $170 billion, beat EPS by 15 cents. $1.80 versus $1.65. AdBiz up 33%. E-commerce business up 23%. We got the stock split going. Yeah, that's the new hot item out there, right there. And then the acquisition of Vizio, which is kind of interesting. So, I'll say Walmart's actually been putting up really impressive numbers. I mean, I'm kind of almost borderline shocked at how impressive Walmart's numbers have been. For a very sleepy company, sleepy stock, they've been putting it up, man. And so good for them. Is it a stock that is interesting to me? No. I still think at the end of the day, Walmart stock is a bit of a mirage, and I don't think they're going to be able to keep up even remotely close to this sort of growth rates over time. And, there was a high inflationary cycle that we went through, obviously, in 22, 23. I think that allowed Walmart to take a lot of pricing on a lot of products that they hadn't been able to do in a long, long time. And I think they took advantage of that. And I think you're seeing it play out in the revenue numbers and EPS numbers. And let's just be honest, they could get away with it. Because at that particular time, everybody was expecting to go into your Walmart every week and pay higher prices. Same thing with the food store and everywhere else. And so I think this is really helping out Walmart immensely, but I do think this goes away, and I don't think you're going to be able to, keep raising prices and those sorts of things. And I think a lot of, why they're beating these revenue numbers, why they're beating these EPS numbers, putting up that, I think a lot has to do with the raising of prices. And like I said, they justified it with, everything's going up, our suppliers are going up. Of course, that's what everybody's going to say, right? But at the end of the day, I think I know what's actually going on there. Okay. So first off, in relation to Walmart, their income statement was a B+. It could have been an A+, but they had a one-off expense here. It was a big one-off expense. See other gains and losses. It was like a $3.8 billion kind of one-off there that hurt their numbers, but it's still a really good quarter overall for the company. But the shocking number for me was right here. Operating income for Walmart was up over 30% year over year. I can't even believe it. I'm like, what? 30% plus operating income up for Walmart? Walmart is one of those companies you usually expect operating income to be up 3 to maybe 9%. Somewhere in there, 3 to 9%. The fact that it was up 30% plus, I was shocked, man. I couldn't believe it. I was like, you better be flipping my flapjacks. How about that? Now, in regards to Walmart, I got to say, they've fixed their problems, at least in the short term here. And they've got a lot of growth going for that company. This was a dog stock. From 2008 to 2018, it was a dog stock. It went basically almost nowhere for that entire decade. It's just it was just in a horrible place. And no one wanted to own the stock. And, I mean, the chart's pretty self-explanatory. Since 2019, the stock's been in a very good place, and respect, man. I'm shocked. That's all I can say, shocked. Now, Home Depot, on the other hand, Home Depot, bad. Net sales for Home Depot down 2.9%. Cost of sales down 2.6%. So cost of sales didn't even go down as much as net sales did. So that's always bad news, because that means your gross profit is going to be down even more than your revenue was down, right? Gross profit was down 3.5% for the company. Selling general administrative was up 2%. Depreciation and amortization was up. So if those are up, your operating expenses are going to be up, right? And those are up 2.7%. Operating income down 12.8% for the, Home Depot, operating income down double-digit percentage? No bueno. Interest income was up quite a bit, but this company has a ton of debt, so the interest expense was up, a lot more on a number basis than certainly interest income, which means your net earnings is going to get destroyed. Net earnings was down 16.7% for the company on a year-over-year basis, and diluted EPS was down 14.5%. So overall, in relation to Home Depot, no bueno. I believe, and here's the thing, okay, in regards to Home Depot, there's no opportunity here. There's no like, oh, let me buy this stock, because here's the thing. Let's say Home Depot's numbers improve over the next year, the next 12 to 18 months or something like that. Because of where the valuation's at, keep in mind, Home Depot should trade at a forward PE of, 15, maybe 17. And so the forward PE is way ahead of that, which means they're already pricing in kind of a bounce back in the business. And the way I look at a Home Depot, I think this is likely going to be a lost decade for Home Depot. I think like 2021 through 2031 will end up being kind of a lost decade for the stock overall, in my personal opinion. I think there's going to be a big recession at some point in time. There's no doubt about that, right? It'll be a big unemployment-related recession. At least somewhat similar vibes to GFC. I'm not sure if it'll be, as bad as that or worse than that, or I don't know. But it's going to be a pretty heavy one. And whether that hits in 25 or 26 or 27, I think it's, there's no predicting exactly when it's going to hit, but it will hit. And so when we have that, the Home Depot stock is probably going to fall in the 150 to 200 range in that particular recession, right? And then after we start coming out of that recession, which that will be a tough one to dig out of, because that will be an unemployment-related recession, which those takes quite some time to kind of get back going in the right direction, because you have dominoes falling for quite some time. So by the time the stock starts to get momentum again, you're talking about years down the road. So imagine stock is $150, let's say, in 2026. We had the big crash. Then it's got to climb back from that. And then it's got to get back to 400 plus. Well, it's going to take years to get back to 400 plus for the company at that point in time, which then puts you out. So I think there's a decent probability that stock could be in a lost decade right now. And in the short term, maybe it could go back to 400 plus, before the next situation happens. But that is what that is, right? Toll Brothers, on the other hand, the business is booming for them, man. It's a grade A income statement. It's phenomenal. I mean, what's there to not like here? Home sales up a ton for the company, revenue up a ton for the company, 1.78 billion to 1.94 billion. Home sale cost of revenues down to 72.4% from 74.4%. That's great. Land sales and other 63.5% from 138%. That was a troubling number in the same quarter last year. That's good. Gross margin 27.6% versus 25.6%. That's 200 basis points of improvement there. It's phenomenal. Gross margin on land and other sales 36.5 from a negative 38 in the same quarter last year. Selling general administrative expenses up 11.9, it was up quite a bit year over year, but it did fall a little bit as a percentage of revenue overall. So income from operations exploded to $308 million. Like, these are all record numbers for Toly Moly in this sort of quarter, right? $239 million in net income, $2.25 diluted EPS, phenomenal. Business is booming for them, and a huge component of why business has been booming for them is what I spoke about in yesterday's video. If you watch my PayPal stock all-time low sentiment, I spoke about 3 subjects in that, and one of those was we talked about real estate in that video, right? After we got through PayPal stock. And I showed you the chart of his existing home sales. I mean, the numbers are horrible. And in terms of inventory on the market, it's still extremely low. And so for a company like Toll Brothers, they continue to kind of be in a sweet spot, because these home builders can buy down rates here in the short term. They're not competing against a bunch of existing inventory out there. And so these guys continue to just be in a sweet spot in the short term. This is going to end. There's no doubt about that. But once again, it gets tough to predict exactly when the music's going to stop for these sorts of companies. The music will stop. It's just like, dude, is it 2 quarters from now? Is it like 3 quarters from now? Is it like 5 quarters from now? The music will stop in relation to that eventually here, okay?